So, yeah. Well, if you thought 2022 was crazy, wait till you get to October of 2022. I think we need to recap. We all know we've had a downtrend this entire year, but look, two big bear market rallies where we basically thought things were over. One rally ended in late March. We thought we were up about 11.5%, and we thought that was it. We're done. And then, oh, wait a second. Let's just decline a little further, down about 21%. Okay, that didn't work out, but let's try this again. We got another rally. Let's go up. Let's go forward. August comes around. Okay, we're up 18%. Wait a second. Up, we hit this downtrend line again. See ya. We're back down. And so basically, if you thought that it's been crazy so far this year, maybe October is going to get a little crazier. I don't know if it's good crazy or bad crazy, but we're going to talk about it because on Thursday of this week, there's a very important date. On October 13th at 8:30 in the morning, this Thursday, we're going to get some CPI data, and woof, what is going to happen after that day, I have no idea, but I am a little concerned. I'm not sure. I don't want to say that I'm bearish. I don't want to say I'm bullish. I'm just generally, let's say, a little bit nervous about that day because I don't know what to expect. Let's go over this. This is the inflation nowcast data coming out of the Cleveland Fed, and basically what they have here is September being up 8.2% inflation. So CPI year over year up 8.2%. That's not good. That's not what you want because the Fed is trying to bring down inflation, and 8.2% is way, way, way too high for everybody. Now, we have core CPI, which we're going to talk about in a second because it's very important for what I'm going to discuss in this video. So 6.64% core inflation. What is core inflation? So there's headline inflation being 8.20, and then core being when you strip out things like energy, when you strip out things like food, you get this inflationary number 6.64%, which is kind of more of like a maybe a better way of describing what inflation is, because energy is so volatile and food can be very volatile too. But then we have something from Macro Alf, and this is a very important tweet that I think that he sent out just recently, and it says every time the Fed had to seriously fight inflation, they always end up raising Fed funds above the prevailing core inflation rate. Why is this important? Well, basically, let's talk about inflation. So you have core inflation and then you have headline inflation. Core inflation is basically you take out energy, you take out food, and these are more volatile types of things that go into it. So maybe core inflation is a better gauge about how the Fed can kind of battle inflation, right? So he's saying, Macro Alpha is saying, that we see all the time whenever there is inflation that's high, let's say core CPI, and they need to battle that, well, the Fed funds is going to be higher than core. And we can see back here, core is about 6.64% year over year in September. It's going to be projected 6.58% coming up in October. So we'll know that in November, right? So basically, this is what he's saying. And that means Fed funds is going to be higher than probably the 6-ish percent if it doesn't start declining sometime soon, right? Because right now, it's way too high, 6 point something percent in core. If it continues, and that happens over the next, let's say, 6 months, the Fed's probably going to end up hiking rates at least to in the 6% area, and that's way higher than the market thinks it's going to be. Let's delve a little deeper, okay? This says it will be months before smaller rent increases show up in inflation data, and this raises the risk of a hard landing for the economy. This is an opinion from Market Watch, and basically the deal is here. They're saying that because CPI measure of rent inflation could reach 8% by the end of the year, this is versus the current rate of 5.8% and the pre-pandemic average of 3 to 3.5%. And what's going on here is shelter and rent and things that go into these types of parts of the CPI are very important. If you look here at the consumer price index, this is the weighting of the components essentially. And what we have here, well, 42.4% of the component of CPI, it's in housing, right? That's a very big part, of course, of what's going on within the economy and inflation. Compare that to things like, let's say, with food and beverages, 14.3%. It's big, but housing, so much bigger. Over here, we can see inflation drivers and expectations. This is from JP Morgan's really great Guide to the Markets. I always suggest people read this if they can find it. Just type in JP Morgan Guide to the Markets. You can find this presentation that they give once a quarter. So contributors to headline inflation, as you can see here, look at this blue line. Blue is shelter. So shelter, look at the increase from August of 2021 all the way up to August of 2022. It's continuing to rise, right? And that is not what the Fed wants to see. Now, luckily, we have seen energy coming down, but I'm going to talk about that later in this video because that's something to keep on our radar. So here Jason Furman is saying rents on new leases are falling. Good news. Will eventually slow inflation. Just don't expect much relief in the official data soon. So here's the thing. So basically when it comes to CPI and let's say shelter or the inflation part of housing and shelter and things like that, sometimes this data that they're looking at, it can be kind of lagging. So they're looking at kind of past data that may not be telling the full story yet. And he's showing here the CPI appropriately, apparently I can't speak, sorry, covers all leases, not just new leases and existing leases likely resetting up. Number 2, the CPI has additional lag. So here's the deal. CPI rent primary index, you can see it's going up, right? Kind of a very much more smooth type of line. We have the apartment list rent index. We have Zillow observed rent index, which are going to be more kind of accurate into real time, right? So what's going on presently right now. And you can see kind of peaking over here with this apartment list national rent index, or at least it's starting to kind of turn over a little bit. And you're not seeing that down here, which is essentially what probably the Fed is more looking at when they're looking at the CPI data, right? So what they're doing is maybe the data that they're looking at is not going to show yet this. It's going to be showing this, which is going to increase essentially CPI even more. And we won't see something like this in the numbers for a few months maybe. Another kind of sub-story about all this stuff going on is that Alessio here says U.S. consumer borrowing rose in August by more than forecast as credit card balances increased by the most in 5 months. So here's the thought on this. Let's go back to 2021. See, you could see 2021, look how low consumer borrowing was, right? So 2021, 2020 to 2021, consumer borrowing, obviously it's going up, right? But it's not at dangerous levels or anything like that. And then it gets to the point where it's just really way higher than any point that it's been on this chart here, right? So you go all the way back to right before 2008, the financial crisis. Well, you're not looking at a very high amount here, right? So this is in billions of US dollars. So of course it's not adjusted for inflation or anything like that, but still you could see the trend going up quite fast. And then we get to this really high number and then it falls, okay? Falling is good because the Fed doesn't want people to borrow that much money to buy things, right? They want spending to decelerate. They want it to accelerate. But this is showing that consumer borrowing is accelerating, meaning that people are spending more money probably by using things like revolving credit. And so what does that do? Well, here it's up now. So we had this, it fell down. So the Fed was probably looking at this piece of data and they're like, that's good. But now they're not looking at it and saying it's good. They're saying that's not good because like we said before, the GDP, or actually I didn't mention this, but last week, the GDP numbers came out and they actually were looking like very good, as in good for the fact that GDP was increasing, which is good. You would usually say, okay, we want GDP to go up because we want the economy to grow. However, the Fed doesn't want to see GDP growing. They don't want to see it growing at a very high clip. They want it to be, let's say not growing as much, right? Because they want the things that they're doing with increasing interest rates to stall the growth of the economy, right? So that essentially inflation doesn't show up and we don't have high CPI numbers, okay? This is not good, basically is what I'm saying. If we come over here, Mac 10 is saying, those wanting to understand what's driving CPI, the speech by Walt Whaler is a must read. So he's a Fed chairman guy, he's a Fed official guy. He says that as rent leases expire, they will be rolled over at new higher rents well into 2023. High interest rates on homes have collapsed rental vacancies. Okay, so what's going on here? Basically, there's not a lot of supply of homes to be rented right now, right? And so that's not a good thing if you're going to try to lower the amount that rent is going to be increasing over time. So we don't have a good supply. And on top of not having much supply in this whole thing, when the leases do expire, they roll over, right? Well, rent's pretty sticky, right? Most landlords, they're not like, hey, I'm going to just decrease your rent because I'm nice. They're saying, well, the economy, everything, I'm going to the grocery store, I have to pay more money. I now have to pay more money if I go to buy a new property to go ahead and try to take a loan out for that property, right? I have a higher interest rate now, so I'm going to charge higher rents on all my properties, right? So these are not good when it comes to the inflationary numbers inside of rents. And over here we could see shelter, and these are kind of the subcategories of shelter, but take a look here. Owner's equivalent rent of residences, 24. So the weighting is 24%, let's say, of CPI. And let's move now from the rent part, or let's say the shelter part, or the rent, or the housing part, over to the energy part, which I said is kind of important too. So Bob Elliott here says this is going to be a real issue for CPI. Energy is directly approximately 10% of the index. So essentially, energy is a decent component of CPI, and it was deflating at 5% month over month. And I'll show you in a second what was going on there, but that is what led to headline falling to close to 0.1%. And up here, you could see the different inflation numbers. See, and in July, you could see it deflating, right, going down, negative 4.6%. Then again, in August, negative 5%, right? And so these were good things, right? These are bullish, right? Energy is going down. We don't want high prices in energy. The Fed's looking at that and they're saying, hey, that's great. Energy is not going up. And now we can see that if we look over here at West Texas Intermediate crude oil, of course, downtrend. This is a good thing, right? It's been going down since about June. This is when it peaked at about $120-ish per barrel. And okay, we're going down like that previous tweet said. It deflated, right? July and August. Okay, we're getting down here. And this little box here is essentially in August. And we can see, okay, it starts here. Most of the time it's on its way down. So it's deflating in August. It did not go up, right? So then we have it falls even further down in September. And so again, we're seeing a little bit, let's say, of sideways, and then it does drop down here, right? And so we have quite a big drop in terms of West Texas Intermediate crude oil prices, but now we have something that looks a little bit scary. So if we draw this as a downtrend channel and a downtrend line here, well, we could see that it's possible that crude oil prices are starting to break up above that downtrend line, which could be bad if it does end up ripping up higher and go back up to potential levels of, let's say, $100 per barrel or something like that. Well, then we're talking about, again, having issues within inflation increasing, right? And so that's not something that we want either. So we have all these things going on right now, and it's kind of concerning because over here we have a headline, and this is from CNBC, and it says, OPEC and non-OPEC allies, a group often referred to as OPEC Plus, agreed on Wednesday to reduce oil production by 2 million barrels per day from November. Okay, so here's the deal. When there's a lot of supply in the oil market, of course, it can hamper demand, right? Well, it meets demand essentially, and so we get supply and demand balances. What happens when they cut supply? Well, demand staying the same, it increases the prices of oil, right? And so that's not something that you want. And then it says the move is designed to spur recovery in oil prices, which had fallen roughly $80 a barrel from more than $120 per barrel 3 months ago. And so this is kind of concerning. So if suddenly now there's less supply of oil going into the market, well, the price of oil probably will end up increasing, which is not something that we want. So this is something that's kind of on the radar too. So what do we have now? In my opinion, I don't necessarily think that the September inflation print is going to look that bad. If you see here, we're looking here at 8.2% of CPI year-over-year growth. I don't necessarily think it's going to be much more than that because of what we saw in the rental market, yes, but then energy part of that component index did not rise that much. So that's kind of what I'm banking on now. Of course, we have core CPI. I'm not sure what that's going to be. But basically, my thought is that it's not going to be as bad this month. So when it comes out, I don't necessarily think it's going to be a very, very negative reaction. However, don't listen to me because I don't necessarily know what's going to happen. This is my assumption because of some of the things I just talked about. But honestly, I don't know. And it could happen that maybe the inflation print comes out actually a bit lower, but for some reason it's still kind of high, like it's still 8% or something like that. And the market still reacts negatively. Like you don't know what's going to happen with the market. The market's kind of schizophrenic, So you don't necessarily know. But the other part about this is I do think if we go over to November, and the next time that this meeting is in November, so we have November over here, if we look, well, the October numbers are going to come out in November 10th at 8:30 a.m. So on that date, I do kind of think that inflation print data may not be looking so good, especially if energy prices are starting to go up and rental and shelter doesn't end up going down at all. So I don't know what's going to happen, but I'm thinking that this could be a little bit kind of concerning in the short term. Now, of course, I'm always positive, optimistic, and I want to always talk about ending this on a good note. And so what I want to say is I'm still buying. I'm still investing. I still think stocks are a great place to hold money for a long period of time. So if I buy now and I hold stocks over the next 10 years, 20 years, 30 years, I'm going to be undoubtedly happy that I bought stocks now and did not wait, months or years to go and buy stocks. So that's all I have for this video. Got a disclaimer here, and if you have not subscribed yet and you're thinking about whether liking this or subscribing, I would say please hit that subscribe button. Don't worry about liking it, and I'll see you in the next video on the end screen right now.